A perfect setup that ends in a loss is not a failure. Most traders spend years believing it is. That belief is the most expensive misunderstanding in trading, and it quietly destroys more working systems than bad analysis ever will. Listen carefully. The loss is not the problem. What you do with it is. Here is what happens in the trading room, in the apartment, at the laptop at 2 in the afternoon, when a setup that checked every box on the list moves in the wrong direction and stops out. The trader stares at the chart. They replay the entry. They ask themselves what they missed. Because something must have been missed. The setup was perfect, the analysis was clean, the entry was precise, and the trade lost. So the rule must be wrong. The checklist must be missing something. The indicator needs adjusting. The time frame needs reconsidering. By the end of that evening, a system that was working has been reopened, second-guessed, and modified based on the single most unreliable piece of data in trading: one outcome. The setup did not fail. The system did not fail. The probability distribution did exactly what probability distributions do. And the trader's response to a statistically normal event began the slow destruction of an edge they had spent months building. An amateur changes the system after a correct execution produces a loss. A professional records the result and returns to the system unchanged. Before anything else, understand what a setup actually is, not what most traders believe it to be. A setup is not a prediction. A setup is not a guarantee. A setup is a specific configuration of market conditions that has historically resolved in a particular direction more often than not. More often than not is the critical phrase. It is not always. It is not certainly. It is with a measurable edge across a large sample under defined conditions. That edge might be 58%. That means 42% of the time, even the perfect setup loses. 42% is not a rounding error. 42% is nearly half of all trades. Every trader with a 60% win rate is still losing 4 out of every 10 trades. And those 4 are not evidence that the system is broken. They are the cost of operating in an environment governed by probability rather than certainty. The market has no memory of your analysis. It does not know your checklist exists. Let me tell you about Nadia. Nadia had spent 6 months building and testing a trading system before she ever risked $1 of real capital. Her back-tested win rate was 58%. Her reward-to-risk ratio was 1.8 to 1. Her profit factor, the ratio of total profit to total loss, was 1.9, meaning every dollar she lost was producing $1.90 back in profit. It was a genuine edge, not spectacular, not the kind of thing that gets shared in trading groups, but real, documented, and tested. Nadia began trading it live in April. April was a good month. May was a good month. In June, something happened that had a 3.1% probability of occurring in any given cluster of trades. She had 4 consecutive losses, all on setups that had fully qualified on every criterion of her checklist. 4 correct executions, 4 losses. She was shaken. She went back through the 4 losing trades and identified what each one had in common. She changed the entry rule to filter for that characteristic. July. 3 more qualifying setups produced losses. She changed the exit rule. August. The system's performance was erratic. She changed the time frame filter. By September, Nadia's win rate had fallen to 44%. Her average winner had shrunk from $340 to $290. Her average loser had grown from $188 to $210. Her profit factor had collapsed from 1.9 to 0.9, meaning the system was now losing money. She concluded the system had stopped working. She was wrong. The system had not stopped working. She had modified it 3 times in response to 6 losses, and each modification had stripped away a layer of the original edge, while adding complexity that made the setups harder to identify and the entries harder to execute with precision. When Nadia finally rebuilt her original rules from her documented notes and held them unchanged for the next 60 trades, Her win rate normalized to 56%, and her profit factor recovered to 1.7. The system had never been the problem. The three rule changes, each made in response to statistically ordinary losing outcomes, had been. Let that sit for a moment before we continue. Here is the mathematics of what was happening to Nadia, and what is happening to every trader who changes their rules in response to single losses or short losing sequences. A system with a 58% win rate will produce the following losing sequences with the following approximate probabilities across a year of trading. 2 consecutive losses happen roughly 17% of the time. If you take 100 trades per year, expect 17 instances. 3 consecutive losses happen approximately 7% of the time, roughly 7 instances per year. 4 consecutive losses happen about 3% of the time, approximately 3 instances annually. Every one of those instances, if treated as a system failure, triggers a rule change. Each rule change subtly corrupts the edge. After 3 changes made in response to 3 ordinary losing sequences, the original system no longer exists. The trader is now running a hybrid of their original rules and the 3 reactive modifications, a system that was never back-tested, never forward-tested, and was designed entirely to prevent the past rather than express the edge. Write this down. A losing streak is not a signal to change the rules. It is a signal to check the execution. Now, there are situations where a perfect setup produces a loss from a cause that is genuinely worth examining, not to change the system, but to understand whether an environment filter needs to be added. There are 4 distinct categories. The first is execution error. The setup was correct, but the entry was not. Not at the right candle, not at the right time of session, not sized correctly, or the stop was placed inside the noise rather than at the true invalidation point. Execution errors are worth correcting. They are not setup errors. The second is external catalyst. A news event, a macro policy decision, an earnings release arrived after the setup formed and before the trade could complete. This is not a setup failure. It is a market environment event. The response is not to change the setup criteria, but to add a pre-trade calendar check to the entry process. The third is market regime mismatch. A trend-following setup placed in a ranging market. A breakout setup initiated during a period of compressed liquidity. Again, not a setup error, an environment filter error. The fourth and most important, pure statistical variance. A setup that qualified fully, executed correctly, in the right environment, with no external catalyst, and lost. This happens 42% of the time in a 58% system. It is not categorically different from the other losses. It is the expected distribution doing what expected distributions do. An amateur looks at a losing trade and asks, what was wrong with the setup? A professional asks, what was wrong with the execution, and only changes the system if the answer points to a structural flaw across many trades, not one. Here is the deeper reason this is so difficult. Your brain is not equipped to separate the quality of a decision from the quality of its outcome. Behavioral economics has a name for this: outcome bias. Research in this field, work that produced a Nobel Prize in economic sciences, demonstrates that humans systematically evaluate the quality of decisions by the results they produce rather than by the process that produced them. A surgeon who performs a technically flawless procedure that results in a complication due to factors outside their control is judged differently, by themselves and others, than a surgeon who performs the same flawless procedure with a clean outcome, even though both decisions were identical in quality. Traders are not surgeons, but the neurological trap is exactly the same. When a trade loses, the brain begins searching for what was wrong with the decision, because the brain cannot tolerate the discomfort of a correct decision producing a bad outcome. It will always find something. Because the pattern recognition machinery of the human mind, when run in reverse from a known outcome, can always construct a narrative about why the result was predictable. That reverse-engineered narrative is not analysis. It is the brain protecting itself from the discomfort of uncertainty by creating the illusion of foresight. And it is the single most destructive force applied to a working trading system. The second trap is what happens after the reverse-engineered narrative is built. The trader uses it to modify the rules. The modification feels like learning. It feels like improvement. It has the emotional signature of progress. But it is not progress. It is the systematic removal of statistical variance from a system that required that variance to produce its edge, because the setups that occasionally produce the 30% of expected losses are the same types of setups that produce the 70% of expected wins. Remove the former, and you remove the latter with them. An amateur feels the urge to fix the system after every loss. A professional feels the same urge and waits for 30 trades before acting on it. Here is the 6-step framework for what to do when a perfect setup produces a loss. Step 1. Before changing anything, answer a single execution question. Did this trade qualify on every criterion of the entry checklist at the moment of entry? Not in retrospect, not after seeing the outcome, but at the time the entry was made. If yes, record it as a correct execution with a losing outcome. Do not touch the system. Step 2. Review the execution mechanics in isolation from the outcome. Was the entry candle the right candle? Was the entry taken at the right session, the right time, the right price point? Was the size correct? Was the stop placed at the actual structural invalidation point rather than at a round number or emotional distance? If all 4 checks pass, the execution was sound. Move forward. Step 3. Identify whether an external catalyst arrived after the setup formed and before the trade completed. Check the economic calendar, the news feed, the earnings schedule. If an external event is identified, note it and add a pre-trade environment check to the process. Do not change the setup criteria. Step 4. Evaluate whether the market regime at the time of the trade matched the setup type. A trend-following setup requires a trending market. A compression breakout setup requires a specific volume and range profile. If a regime mismatch is identified, add a market environment assessment to the pre-entry process. Do not change the setup criteria. Step 5. If none of the above 4 checks identifies a specific correctable error, accept the result as statistical variance. Record it in the trading journal alongside the current running win rate and the expected win rate from the system's documented history. The trigger for a genuine, justified system review is not 1 loss, not 2 losses, not even 4 consecutive losses. It is a sustained deviation of 15 or more percentage points from the expected win rate across a minimum of 30 trades. 1 result is not a sample. 30 results begin to be a sample. Step 6. Return to the system unchanged for the next setup. This is the step that costs the most, not financially, emotionally. The impulse to do something, to fix something, to modify something after a loss is powerful and feels responsible. Resisting it feels passive and uncomfortable. But the discipline of not reacting to a correct execution with a bad outcome, of trusting the sample size over the individual result, is not passivity. It is the highest available form of active discipline in trading. The system deserves a verdict from a sample, not from a single trade. If I broke my rules, even profit was a loss. If I followed them, even a loss was a win. Read that again. Because every system that ever stopped working did not stop working because the market changed. It stopped working because the trader kept changing the system in response to the market's normal behavior, until the system no longer resembled the edge that had been tested and proved. The loss was already priced in before you took the trade. The 42% of losses was already embedded in the 58% win rate when you decided the system had an edge. You accepted that distribution, implicitly, the moment you chose to trade the system. The loss on the perfect setup is not a surprise. It is not a signal. It is the distribution arriving on schedule, as it always does, asking you one question. Do you understand probability well enough to let this pass? The professionals who build consistent returns are not the ones who never lose on a perfect setup. They are the ones who have made peace with the fact that they will. They record the result, They review the execution. They find no error. And they close the journal, walk away from the screen, and return to the next setup with the same checklist, the same criteria, the same rules. Because they have understood something most traders spend years trying to unlearn. The loss was not a mistake. The loss was the system working exactly as a probabilistic system is supposed to work. Execute correctly. Record honestly. Return to the system. That is the complete discipline. The real reason a perfect setup ends with a loss is not that the setup was wrong. It is that you are operating in a probabilistic environment, and probabilistic environments produce losing outcomes on correct decisions. That is not failure. That is mathematics. And the trader who finally accepts it stops changing the rules, stops second-guessing the checklist, and gives the system the one thing it always needed and rarely received. Enough trades to prove what it is. If you have ever changed a rule after a loss that you now realize was correctly executed, type the distribution in the comments. And subscribe now, because the next video covers the complete trade journal framework, the exact process professionals use to distinguish execution error from statistical variance, so that system reviews happen only when the data justifies them, and never when the emotion demands it. The setup was right. Trust it long enough to find out.